But let's go across and introduce Hemant Rustagi of Wiseinvest Advisors. He is our personal finance guest for the day. Hi Hemant, thanks for joining us. Let me go across to our first caller. Kumar Rao is on the line with us from Kerala. Hi Kumar.
Hi.
How are you?
I'm fine. My question, I'm new to investing in mutual funds. Right now I have FDs, life insurance, health insurance. So what would be the best investment option in the mutual fund space to get a regular monthly income for my retirement years?
Okay. Hemant?
Well, I would say, I think, first thing is that generating regular income, or rather on a monthly basis, can be quite a challenge for after retirement. That is because, one, there are very few investment options that provide a return on a monthly basis, and also at that stage one is not in a position to take too much of a risk. But fortunately, I think if one follows a proper strategy, one can generate regular income. So the first part of the strategy should be to, accumulate as much as possible before one retires, so that even with a moderate kind of return, one can generate adequate income. The second is, before deciding where to invest for generating regular income, I think it's very important to ascertain what kind of income one would require. So in this case, for example, if his monthly requirement is, let's say, 50,000, I'm just assuming that if he has a corpus of, let's say, 1 crore at the time of retirement, he would need to generate a return of around 6% to get what he wants to. And even if I consider inflation, over a period of time, maybe 7 to 8% return would suffice. So I think it's very, very important first to ascertain what kind of return you would require after retirement. And also don't forget that if you're still in the accumulation stage, your focus should be to invest in those investment options where you can beat inflation. So maybe, add some market link products. As far as the mutual funds are concerned, I think they offer monthly income plan to investors, which are popularly known as MIPs. These are essentially debt-oriented hybrid funds wherein 75 to 80% of the money is invested in debt instruments, the balance is invested in equity. So this asset allocation actually has the potential to provide better return than what banks and other small saving funds can give you. But the returns can also be erratic. So one has to be careful in terms of how much exposure you should have to this. And another dampener could be actually that these funds, when they pay dividend on a monthly basis, they pay actually dividend distribution tax of 25% plus surcharge, which can actually reduce your post-tax return. So it has to be a mix of different funds to ascertain that you have adequate money to meet your monthly expenses. Another option for mutual fund is to opt for a systematic withdrawal plan, whereby you can actually invest a lump sum money and give standing instruction to the fund house to take out a fixed sum every month, which can be used for your monthly income. Now, ideally, this money should be invested in that fund at least a year before you start withdrawing your money, because that will make your return more tax efficient. Now, for example, if it happens to be an equity-oriented fund, the capital gain, long-term capital gains are tax-free. And if it happens to be a debt-oriented fund, then you have to pay only 10% capital gain. And if you claim indexation, maybe even less. So I think you need to go step by step, ascertain how much money you need every month, look at how much corpus you have. That will help you in knowing what kind of return you need to generate, and then look at your asset allocation so that you're not taking any extra risk that you're required to take.
Okay, we're running out of time, so let's quickly get an SMS also. We have an SMS query coming in from Soham Biswas, who writes to us from Kolkata. He says he has been using fixed deposits and long-term bonds to invest his surplus savings. He also has dabbled a bit in mutual funds. Soham says he plans to quit his job now for a few years and wants to invest in some steady growth products. Hemant, what would you recommend to him?
Well, I think there are two important factors for any investor to make investment decision. One is obviously the time horizon, and the second one is existing asset allocation. And in this case, the time horizon is 3 to 5 years, and the existing portfolio consists of bank deposits and traditional investment options. So I think there is definitely a case here to look at some equity-oriented fund or equity-oriented balanced fund. A couple of funds I would recommend here is ICICI Focus Blue Chip Fund and Birla Sun Life Frontline Equity Fund on the equity side. And on the balance side, he can look at ICICI Balance or SDFC Prudence. But he needs to remember that because the time horizon is 3 to 5 years, not more than 30-40% should be invested in these funds. The rest can still go into debt-oriented products.
Okay, Hemant, thanks so much for joining us. On that note, it's time to wrap up this show. But here's our closing bell, money control question of the day. After Delhi, Maharashtra to cut power tariffs. Is our
MCX Stock Exchange, India's new stock exchange, presents Markets and